Hey everybody, Lawrence here, Financial Thing. The Friday evening or daytime or morning, wherever you are. Investing live stream, talking about peer-to-peer lending, amongst other things, and general investing. My voice is a little crackly today, so apologies in advance if I cough in your ear. Apparently I cannot keep away from the airborne lurgies that are going around at this time of year, so that's why I wasn't here yesterday. I wasn't feeling very good, but back at it now. I hope you guys are all doing well. Thank you for joining. Please subscribe to the channel if you haven't already. Hit that thumbs up button. You know, it only takes 2 seconds to do it. Really helps out. What are we talking about today? We're going to talk about some peer-to-peer lending news. Prediction in peer-to-peer lending yield rates. And we're going to talk about crowd property raising funds on Cedars. A little bit of easy money news, some lend invest news. And we're going to talk about the inflation numbers that came out a couple of days ago. See what everybody is unhappy or happy about with regards to that. Take a look at the markets. We're going to look at the trading 2-on-2 portfolio that has been absolutely taking a bit of a beating over the last couple of days with some severe volatility and stomach churning ups and downs that this market seems to be providing. This kind of sideways ebb and flow that some have predicted is going to be a while. For anybody that's interested, it is really bloody hot here in Orlando today. I think it's over 30 degrees, which is ridiculous for February. For anyone that says global warming isn't a thing, weird. I mean, it's supposed to be winter time, but alas, very hot weather. The air conditioning is blasting. The dog is scratching, but everything is good. Happy days. Anyway, let's have a quick hello to everybody who is joining. Thank you again for being here. Again, apologies about no Thursday, but we'll try to get back on track next week. Peter Vince is giving up the stream to go talk, listen to a history talk about D-Day involvements by a local. I understand, Peter, sometimes. You know, you have to get your priorities straight, and it's all good. But you can catch up. Mike Powell is here, of course, in Southampton. Chimpo Naughty in Cambridge. Hello, Darren. How are you? Double D. Dave Dawson, the dividend guy. Paul Bagworth in Kenilworth, Halland, Stratford. Just in time. Yes, you are. Welcome. J.M. Roberts. Balmy weather here in Toronto, Canada. Minus 17 this morning with wind chill. I mean, how different could the temperatures be? 2 hours north by plane, minus 17. 2 hours south by plane where I am, 84 degrees or 30 something. I don't know. It's crazy. Anyway, I don't understand it. But also, it doesn't really matter what the weather is at the end of the day if we're happy, right? Anyway, let's crack right into the news because I am blathering. I'm a little off kilter. Thankfully, it's not COVID again because that would be absolutely ridiculous. To get COVID twice in a month, 2 months, would be unprecedented. Maybe I have heard of that happening. Okay. RoboCash predicts 12.6% average peer-to-peer yield rate in 2023. Sounds very, very, very high to me. European peer-to-peer lending platform RoboCash has forecast that the average yield rate of peer-to-peer fixed income investments in Europe this year may reach 12.6%, returning to 2017-2018 levels. The current peer-to-peer lending market average of return of 10.5% has exceeded the overall average for the last 4 years of 10.4%, which RoboCash said suggests the market is gradually recovering. Now, for those of us that invest in the UK side of peer-to-peer lending, those numbers sound particularly high because they are. European platforms tend to offer much higher interest rate loans on their peer-to-peer lending products, which I consider to be substantially more risky the way things are in Europe right now, and some of these Eastern European countries that are seeing much, much higher mortgage rates than the UK sees. So 12.6%, really not a stretch when you consider the average loans. I've seen stuff on Bondora in the 25% return rate. Again, you have to think about the risk that you're willing to take. I think if you're investing in just UK peer-to-peer lending companies and you diversify across a few different platforms, taking lower risk, medium risk, and high risk, you're probably looking somewhere in between 6 to 7% would be an expected reasonable rate of return. Of course, you can opt for less risk. Put more of your investing in lower risk companies with lower risk products. We'll go for the higher risk too, and forget about the low risk. Really depends on what your appetite for risk is. But I found most people that tend to watch the Financial Thing channel and read the website are people that like to diversify across different platforms just to spread the risk out, and are generally looking around 6 to 7% returns per year. But RoboCash is saying if you want to go for that higher risk European style investment, prediction of about 12.6% is possible. Now, one thing that you can do as part of the diversification of investing in the UK platforms is take a percentage of the money that you're okay risking and invest that through a European company like RoboCash, or I don't think you can do Mintos right now, but there are a couple of other peer-to-peer lending companies based in Europe if you wanted to take on that excessive risk and diversify your portfolio out. Personally, I wouldn't like to take a big percentage of what I'm willing to risk and put it into European companies, because I just feel like if something goes wrong with one of those companies, there's really not much recourse for somebody outside the EU. And there are also certain restrictions to UK people being able to invest in some of those European peer-to-peer lending companies because we're no longer part of the euro. So just some things to bear in mind if you are considering companies like Bondora and places like that. Moving on, Crowd Property is about to launch fourth funding round on Cedars. They are trying to raise money again. This is the fourth equity fundraising on Cedars the Crowd Property is doing to support its mission to transform property finance. Crowd Property last raised money on the equity crowdfunding platform Cedars in August of 2021. It raised $1.8 million from over 790 investors. And they have raised a total of $3.9 million in equity capital plus a $1.1 million fundraise in March and $900,000 back in November. So they've gotten quite a large amount of equity capital from raising money on Cedars. It's not live yet. You show it to you. If you want to go and look at doing this, you can go to Cedars and then search for Crowd Property under the Coming Soon section. It's listed in there. The thing about Cedars, and I've talked about this before, because I often get asked, do I do Cedars investments? And the answer's always been no. For me, it doesn't really fit my profile of investing. But Crowd Property is a solid company, I believe. However, this is just investing in equity shares for the company, not really my cup of tea. This is the reason why. If you look at some of the results from Cedars, you're going to see some shares have done very well. On the surface level, it seems like you could make a lot of money if you were just flipping equity shares on the secondary market. You can see Revolut here, one of the unicorns, up 5,022%. So these people were very lucky, the 3,500 that invested in Revolut. And then some pretty good showings for some of the companies on Seedrs. But then on the backside of that, you also have some that have gone down substantially. So this is valued at 47.1 million, that went down 92%, Jaja UK. If you go down, you could see a lot of companies that have not done well, have lost 50-60% of their value. It seems like even here, Assets Exchange down 34%. So there is, these shares prices are based on demand and supply. There is a substantial amount of risk. There's a liquidity risk. There's a demand and supply risk. There is no guarantee that you are going to actually be in the green or in the red when you buy equity fundraising shares, which is essentially funding these companies, right? You're not buying any kind of a lending product. You're essentially giving a cash injection into this company, and they're giving you equity shares. Exit can be difficult. Again, if there's no liquidity, then it can be hard to get in and out. If for some reason the economy changes and people, these things fall out of favor, you could possibly get stuck. But just be aware if you are thinking about it. Do your own research, do your own due diligence, and just note that some of these companies do go down in value as well as up. There seems to be more that have gone up than down. Nippy Groceries has been one that's gone up 18,600%. That is not normal. And also remember, if you're looking for the highest returning shares on Seedrs, you're probably getting in at the wrong time. If the shares are up 18,600%. You got to try to find the ones that you're buying in at the right time, so you don't make a mistake. It's a difficult one. It's very risky, and it's difficult to figure it out, which is why I don't do it, because I don't have the time or the expertise to try to figure out which of these companies is going to be the right one to invest in. But if you do want to, crowdfunding is going to be going live soon for Crowd Property, and you can get priority access here to be able to have that offer, because I bet it is probably going to go pretty quickly. This is good news for peer-to-peer lending in general. There is going to be a predicted UK building boom in 2023. The UK looks set for a building boom, having seen the highest level of planning applications granted in recent months, according to research by debt advisory specialist Serious Property Financing. It found 24,000 planning applications are made each month. That's a lot of applications. We're talking about 24,500 a month. That's over 250,000 a year. And 84% of those are successful planning applications, so not many denied. Northern Ireland had the highest average monthly approval rate for planning applications, with 95% of all applications given the green light, followed by the Northeast England at 92% and Wales at 87%. Why does that matter to you? Well, peer-to-peer lending is very strongly based at the moment around real estate property development. So there's a lot of applications coming out for development. That's a pool of borrowers that these peer-to-peer lending companies can go after, which means for you as an investor, you're probably going to see a lot more loans through companies like Cufflink, Blend Network, Crowd Property, all the PropLend, all these different companies, maybe not PropLend, but the ones that offer development and bridging lending finance. You're going to see a lot more new loans being offered in 2023. The Southeast England looks set for the biggest building boom in 2023 so far, with 4,491 planning applications made on average each month. 84% are successful, 75% in London, lowest percentage of successful planning applications, so 25% denied, 75% approved in London. But despite this, 3,444 successful bids, so successful planning applications in London. So you're going to see companies like Capital Rise take advantage of things like that. Easy Money exceeds £250 million of loans in their first 5 years. They've celebrated 5 years in business. The Easy Money property lending platform was launched in February 2018 under a licensing deal with EasyJet founder. I cannot pronounce this name, but his first name is Stelios. Easy Money has reported $255,305,000 in loans written and deployed, and $105.7 million of loans repaid, with £18.3 million of interest paid back to investors. Those are very, very healthy looking numbers. Average yield to investors on the retail side, 6.98%, so almost 7%, with zero capital lost. And the lowest rate on its platform right now, 4.53%. It's pretty sweet. I mean, those numbers are looking good if we go look at Easy Money's statistics. They have two sides. They got the bridging and development loan. You can find this at easymoney.com if you want to take a look at it. Again, not financial advice. I don't invest through Easy Money. I think it would be a consideration, though, because of their outcome statement. And they've got an average loan to value of just 55.27%. The development size average loan size is quite big, 5.16 million pounds is the average loan size, with an average LTGV, loan to gross development value, 62.95%, right? They've hit pretty good numbers. If you look at their target rates for 2022, the first 6 months, target rate 4.05%, the actual rate 4.04%. So most of their target rates were hit. There's a couple that fell a little bit short. Here you can see that classic 3, which is 1st of January to the 31st of March, fell about 0.32% short. So again, the rates that they offer are just targeted rates. They're not guaranteed. You see a couple of them here. This targeted rate for premium fell a little bit short. So sometimes companies can over promise and under deliver. You can see here, this is one of the few that actually returned more than the target rate. So that was the high net worth product. It delivered 0.9%, but do be aware when you invest in these companies, right? They are going to they're going to offer rates that are not guaranteed. They're always just a prediction of what they think they're hopefully going to be able to offer you. Right, you see here, these important words: target rate, target rate, target rate. So sometimes these target rates are not going to get hit. You might find yourself 0.25% less than that. So, when you're considering risk versus target rate reward, just kind of be aware of that. And if you want to look at those numbers, you can go into the statistics page, which is normally found at the bottom right here under key information. Most peer-to-peer lending companies have these statistics available for you. You can find out what's going on. This is a pretty beautiful number right here. Actual arrears, defaults, estimated defaults, and actual defaults. If you look through the years, Easy Money is 0. That's a heck of a track record. Almost seems a little too good to be true, but that is what it is. So Easy Money might be a place to look at to deploy some money. Just because they have this outstanding track record and they seem to be doing things in the correct manner. The money platform put out an outcome statement recently. We've had, right here, if you want to go watch the Q&A session I did with George Huntley, who is the leader of the money platform. We did a live stream Q&A about 4 months ago. It's on the Financial Thing YouTube channel if you're interested in learning more about the money platform. But here's the outcome statement for the money platform. So you can look from going back to 2022 to the 2022-23 forecasted annual returns. The delinquency rate's going to be somewhat higher just because of the nature of their business. You know, they're lending short-term loans, usually pretty high interest rates. So you can borrow £500 for 6 weeks. You're going to pay £147 in interest, which is pretty much about 255%. So these are probably people that are, you know, desperate to get hold of some short-term money. What that means is you're obviously going to have delinquency rates. It just comes with the nature of the lending. As you can see here, if you look from 2021, the delinquency rate was 13.6%, which really isn't that bad when you consider what type of lending they do. And forecast lifetime annualized return and delinquency rates for 2022 and 2023 were published, of a net return of 5.5% to 6.3% for you as an investor, and default rate of 7%, delinquency rate of 10.5%. So gross return obviously being a lot higher because you've got fees and losses that get calculated into the gross return of 13.1%. You see these numbers are kind of all over the place. If you look back here in 2021, they had some net returns of 23.6 to 27%, which is kind of crazy. So obviously lending changes, the demand and supply changes, the interest rates change. But it is an interesting type of short-term lending. I mean, you can borrow for 12 weeks. So if we borrow £1,000 for 12 weeks, how much are we going to pay? We're going to pay £448 in interest. So a pretty big spread there in fees and interest, which again, you have to consider how much risk are you taking for the return that you're getting. You know, that's £448 of interest on $1,000. It's basically 44.8%. It's a lot. So it's interesting. If you want to go look at their outcome statement, you can go to themoneyplatform.com and then /outcomes-statement. You can kind of look at their statistics, and we've got a bunch of information here if you want to read through all of that there. But I thought it was interesting. Excuse me. This is going to be a short stream tonight because my voice is kind of struggling. I hope you are okay with that. Appreciate you being understanding. Lend Invest. These were the monthly platform information. It was released in January. I didn't get a chance to go through this. This is for December of 2022. This is the latest one that I have. Lend Invest is just continuing to be that slow and steady platform. Again, not peer-to-peer lending strictly. It fell in to what was supposed to be peer-to-peer lending at the beginning. So they've remained on the radar of this stream simply because of they're kind of peer-to-peer, but they're not. They're not technically, but I still view them, you know, theoretically peer-to-peer lending, but technically not. Our average rate of return is about 6.3% from the December fact sheet. They still have very reasonable loan to values of 60%. So I've continued just to take the money that I've had in Lend Invest for several years, just kind of roll it over, and personally not had any real problems. They do have only 3% in arrears right now, but out of term is 19%. So out of term is considered a loan that has not been paid on schedule, right? And there has been an unauthorized extension on the loan terms that have been breached. So 19% is a little bit high. 6% enforcement, so that means outstanding debt is now in recovery. The 19%, you'd rather not see that. Something to keep an eye on. This is why I like looking at these platform fact sheets, because it does have transparency on what's going on. So, but it's been like that for a while, and still Lend Invest continues just to keep plodding away and keep writing new loans. They posted 13 new investments in December of 2022. So they keep on providing more and more opportunities there in the investment side. I found this really, really interesting. This was revealed the world's most Googled investment questions. So this is where basically Google looks at all of their data, and then you can see a list of what people are actually searching for when it comes to investing. I like reading stuff like this because it shows what the world wants to know about. Here's the top 10 most Googled investment questions. Number 1, coming in at number 1, how do I invest in cryptocurrency? This was searched an average of 150,400 times each month. So despite cryptocurrency having its quote-unquote crypto winter, where we've seen these prices that are depressed, there's still this massive, at least search want, of people looking to invest in cryptocurrency. This has not been something where crypto has just fallen off the cliff. Even despite all the scandals and problems that crypto is working its way through, people are still looking for opportunities to buy into it. I think that's very interesting. Second question, how can I start investing? Third question, how much should I invest when I start? It's an interesting question. Fourth, what should I be investing in right now? Yeah, I mean, I would certainly go to the internet to get that answer, right? What should I invest in right now? Number 5, what is passive investing? It's a good question. Passive investing, in my opinion, could be considered a couple of different things. Number 1, it could be an index tracker. It's a passive fund that's not actively managed. Generally, what people are implying when they talk about passive investing, it's stocks that provide a dividend and some kind of passive income. Pretty normal question to be asked. Number 6, how is return on investment calculated? Number 7, is cryptocurrency a good investment? 8, how can I trade safely? Number 9, what's the safest investment to make? That one's easy. I mean, the safest investment, I think, by far, investing in government bonds. Now, of course, you have to invest in the right governments, but I think generally developed countries, UK, US, Australia, you pretty much invest in government bonds and be okay. You're not going to make any money. It is an investment. Probably going to get paid very little, but it's probably the safest investment. Again, not financial advice out, but that's what I believe. Number 10, what are investment bonds? That would be the 10th question. Pretty interesting questions. Again, surprised that actually to see that crypto, how do I invest in crypto, is searched, the most a lot more, almost 20 times more than the 10th question, which is what are investment bonds? This is interesting. I have fallen prey to this. When I first got into peer-to-peer lending, I used to check my account balances every single day, if not multiple times. It's kind of like an addiction. A third of investors check their balances every single day using investment apps. 9% check their apps multiple times per day. What I've found that I do now is my peer-to-peer lending stuff, which is kind of on auto invest. I don't really check very often. I keep up with the news about the companies itself. My like other investing stuff, index trackers, I don't really check too often because I'm not trading or doing anything with them. Individual stocks that I own, those are the ones I tend to look at more often, which when they're not doing well, I don't look at them much. When they're doing well, I tend to check in on them more often because I get scared. For instance, recently I've been seeing the markets and what they're doing. It just kind of makes me depressed when I see one of my stocks has gone down 20% in a day. But I don't know if you can relate to that when you probably, maybe when you first got into peer-to-peer lending, you were logging into your assets capital, or God forbid your Lendy account, your Money Thing account, checking it all the time, and it's probably not the best use of time. It could be really unproductive. So I thought I was the odd one for doing that. But apparently, there's 9% of nutters out there that check their apps multiple times a day, and 35% who, check it every day. So, not alone. Let's look at what happened with the U.S. inflation numbers. I think we're going to see this same thing happen in the U.K. in the upcoming. I don't think the U.K. CPI numbers have been released yet, but these are important numbers. Consumer price index for all urban consumers increased 6.4% from January 2022 to January 2023. Consumer prices for shelter increased 7.9%. It's crazy. I mean, if you look at the food and energy, look at this. Major categories of food, 10.1% up from a year ago. Energy, 8.7%. This is why they group it in together. I mean, food, energy, and shelter are really the three main things that we all get affected by. Obviously, in the UK, these energy prices are going to be off the charts on this graph because they've gone up so much. But there's been a very, very false sense of, this is okay, because while the numbers are a little bit better than last month, it's not really okay because these inflation rates, yes, while they are cooling versus last month, they still have increased from a year ago. So if we start to see this cooling at maybe 0.5% per month, it's going to take a while for those inflation rates to come back down again. Now, who's to say that we don't see another increase in inflation upcoming in the next few months? I think it's very possible, and I think that we're going to see this happen in the UK. While it's not going to be 10% like it was last month with the inflation numbers, I bet you're going to be in the 9s. And I bet that the UK is just really going to follow what the US is doing with its inflation numbers. This is why we're seeing these weird, just crazy stock market fluctuations where they're just kind of going sideways. And you can see this with the Trading 212 portfolio that has kind of been all over the place. I mean, if we look at the 1 week chart here, look at these numbers right here on the left. Still things just kind of flatlining, and then boom, down, back up again, back up again, back up again. You start to think you're making some progress, back down again. Even the 1 day charts are looking just very strange. These kind of straight lines, and then you'll get a dip, and then, you know, it wouldn't be surprising if you wake up tomorrow and you start to see this again. Calera has been just a roller coaster ride. Starts off here. This is a 1 day value. Drops down under the dollar amount. This was at 120 something just a couple of days ago. See here, almost 130. Just absolutely craters down to 95 cents. So loses 30% of its value, literally in a day. Actually 2 days. And then edges back up again. So this is why the portfolio has really been very difficult, because you start to feel like you're making some progress with it, and then, you know, one of these stocks will just kick you in the ghoulies and send it right back negative again. Even Walt Disney struggling. All right, staple blue chip stock. Vermilion Energy down 29% in the portfolio, just really struggling to make any type of traction. Up here from 19 3 months ago down to 13 again. Very, I would say, somewhat high risk stocks. Zim making a bit of a run, you think, and then falls off the cliff and then back up again. We're talking about, you know, 10% movements in a week. So it does provide some excitement, I'm not going to lie, but, you know, you have to be careful and remember. There was an interesting news story, too, that I read about people checking their portfolio. Actually, well, it's right in here. It says in this article, the low barriers to entry in the saturated investment market means users with little experience can quickly get encouraged to risk their hard-earned money on products and trades that they don't fully understand. Now, we're talking about a portfolio in here that, to me, is not an unsubstantial amount of money, 18 grand. I mean, it's a chunk of change. I mean, some of you it may not be. To me, 18,000 is a chunk of change. Now, I could quite easily blow this account by making some ridiculous trades on some very risky things. This is what that article is talking about right here. People can literally take their entire life savings, put it in a trading 212 account like this, stick it in a couple of stinky stocks like Ginkgo Bioworks that is supposed to have done something that it hasn't done. And so instead of it being up in the green, it's severely in the red, and lose their life savings. So, you know, it's very interesting. This is why, too, it's important. You know, if you're a long-term investor, really, I think the best advice I ever heard was check your portfolio once a year. January 1st, do your index tracking investing, do your ISAs, contribute. Don't look at it for a year. There's no need. You're not trading in and out of a long-term portfolio. There's no need to be checking it all the time. Slow and steady wins the race. You don't want to make an emotional decision based on, you know, looking at, say, FlexLing, which is up 42% in the portfolio, thinking, well, this is doing well, I'm just going to buy more and more and more of this. It's not always the right move. So I actually like that advice, checking the portfolio less often. But the portfolio is not doing that great. We've got 822. But actually, today would probably be a good day to deploy that 822 pounds. Maybe we should just do that now. What do we? Deutsche Bank has been doing pretty good. So I'm thinking, where does that money go? My instinct says put it in to something that is getting pretty hit today. So could put it in Calera. I think we might take a risk in that way, or go for something a little bit more stable like Deutsche. You know what? I think we're going to risk. Let's do it. 822. Let's see. This is, I've been seeing this stock just trading all over the place too. If you were into trading, which you shouldn't do ever, if you were, you could probably make some money off seeing chart action like this going up and down. That's how you make money trading, but not advisable at all. So let's deploy 822.22. Here, I'm gonna get this money deployed today because Calera is really taking a beating. Boom. Look at that, live and direct, so you know this is real. Now we have 322.22. See this block for pending order? Low liquidity. Another risky part of trading small cap stocks like that. The order hasn't even gone through yet. We'll do the other 322.22 in I think we're just going to put it in Deutsche Bank. No, we can't because the market's closed. I'll put it in tomorrow. Yeah, I'm probably just going to shove that in Deutsche Bank just to balance this out a little bit. This is still, has this trade gone through yet? Let's see. Come on. No, look at that. Still hasn't gone through. So that means there is no liquidity in Calera at the moment. Risky. Let's look at the Bitcoin market very quickly. Bitcoin has been doing some volatile moving itself, but has still continued to float hard. 24,798 US dollars. You can see we are exactly where we were one day ago. So we saw a big drop, 23.6, and all the way back up. But I've been surprised at how well Bitcoin has been holding steady considering what Bitcoin has been through. And I continue to stay the course with it. I'm a believer. For right and wrong, I continue to cost average in every month into Bitcoin. I think these prices are, of course, they're not as good as they were back when it was 16K. But you can see a pretty big price movement just in a little bit over a month from 16 up to 24,000. So it's an 8 grand price movement. Yeah. What does that mean? Short term, probably nothing. I wouldn't be surprised if Bitcoin, if this is just a fake out and this, comes back down in the 16,000 range. I don't think so. I think we've seen this bottom in here at about 22 grand. But we shall see. There is no guarantees with this stuff. This is high octane, high risk investing, taking a small percent of liquid net worth, doing research, thinking, does this really make sense? Does this Bitcoin make sense at all? To some people, it's not going to make any sense. To me, it makes a lot of sense because of what's going on in the world. But whether that gamble will pay off, we'll have to come back in 10, 15, 20 years. Hopefully I'll still be around doing this and we can look back and say, wow, remember in 2023 what Bitcoin was doing. Hopefully we'll all be around then. We can come back and look and see if that paid off. We'll see if Bitcoin's at 3 grand or if it's at 300. Who knows? Anyway, I think that's what I got for you today. Oh, excuse me. See if you have any interesting comics, and I'm going to get out of here. Good evening, Steve E. from Macclesfield, and Philip from Milton Keynes. I invested in RoboCash, Alan said, for 3 years. I had no complaints. Very cool. Why'd you quit? Both ways giving Lenwise a top star rating. Annabelle. Hola. ¿Cómo estás? Hello, Stephen in Nottingham. Has anyone invested in Source Capital? I have not. Alan Toombs is here. Evening. UK inflation numbers came out this week. I missed it. Down to 10.1. Oh, I thought they were going to be in the 9%, so. I was expecting lower. See, that we get faked out into thinking that 10.1 is okay because we've been so used to seeing numbers that are high, and then we see something that's a little bit lower. You get faked out into thinking, oh, things must be getting better. But if we put that into perspective, that inflation is actually 10% higher than it was a year ago, those numbers are just crazy. VTI plus 7.65% year to date. That is the Vanguard tracker, yes, that I think is a good play. Oil is heading down, hence your energy play is not doing so well. Yes, but for how long? I see energy moving up and down. Last week it was higher. This week it's lower. Oil is not, there's limited supply of this stuff. WH, last week, you looked at Just Us. I haven't heard of them and interested to find out more. However, I can't find any reviews. I'm actually trying to get Just Us onto the stream, so I would say do your due diligence, but have a little patience. And let's find out more about them. Patty, good evening. How are you? Mike Powell, I got a whole 2p dividend from that bit of ASML share today. It's not going to buy the dog any dog food. Binance under pressure, a lot of outflows from the stablecoin. Not surprising. But if 154,000 people are Googling, how do I buy crypto? They got to buy it from somewhere. There isn't that many places you can buy it from anymore. So, what do you think that's going to do to the price action? It's going to go up, I think. Anyway, let's get out of here. I know you guys have got things to do. I'm going to get out of here. I'll see you next week. Have a great weekend. Thank you again for being here. I do appreciate every single one of you who tune in diligently every week. Thank you for supporting the channel. Please consider becoming a Patreon subscriber. Links are in the description. It helps out a lot. No obligation, of course. See you next Thursday. Have a great night, everybody.